Good morning, good afternoon, good evening, wherever you are, right? I'm glad to have so many people who joined today. We have about 80 people who RSVP'd. So clearly, there's a very strong interest in learning about the new tax residency rules and just asking questions in general about all the things that are going on, right? My name is Mohammed Ridwan, or you can call me More Ridwan. I'm the Chief Operating Officer at Pluto Card. For a little bit of background, Pluto is the number one corporate card and spend management platform specifically built for UAE that has direct integrations with several accounting softwares, including NetSuite, Microsoft Dynamics, QuickBooks, and all other major platforms, right? What Pluto offers is unlimited corporate cards for petty cash management, an account payables module, along with purchase ordering systems, right? In addition to that, we allow you to do complete control over your employee reimbursements and many other features that allow you to essentially manage your entire corporate card and spend management in one place, right? With me today is SA consultants, Saqib and Mohammed. A little bit more background on SA. SA is one of the top accounting advisory firms in the UAE. They primarily focus on corporate taxes along with other accounting services as well. Saqib, Mohammed, do you want to give a quick introduction for yourselves for all the people who are not familiar with you?
Hi, thank you so much, Ridwan. Thanks for having us and arranging all these, follow-up sessions. Really, really wonderful. To be always with you to discuss all these new things and changes. So me and my partner Omar, we both are running a local Dubai-based auditing firm named SC Consultants. We are into auditing, accounting, taxation, and we are a full-service firm. Specialized in, of course, in the financial sector. We've been serving clients from so many different sectors: trading, IT, manufacturing, service industry, and all of these. So, yeah, and here we are to discuss the corporate tax updates one more time.
Perfect. And if you are joining us today, leave your name and say hi to us in the comments. Looks like we have James who just put in a comment there. Good to meet you, James, and thank you for joining us. James is the head of finance and treasury at Tact, and he has joined us today. Fantastic. And yeah, if you are live with us, do put in your name and say hi to us. Would love to hear from you. Awesome. So let's get started. There's actually, since the last time we did our last webinar, there's actually been tons of changes that have happened in the ecosystem of corporate taxes and just general taxes in itself, right? Specifically, the UAE Cabinet of Ministers announced a new decision in September of 2022 that introduces new criteria and definitions for determining the status of an individual or legal entity as a tax resident of the UAE under any UAE tax law or bilateral tax agreement. So that's like a pretty significant thing that we want to cover today because it has several implications. The decision actually came into effect about 2 weeks ago on the 1st of March, which was a big thing that has happened recently. So today we want to cover, what does this mean for you, for your business, and for everything else, and also answer as many questions that you have, right, regarding that. Now, okay, so as mentioned, we have here with us tax experts Saqib and Mohammed, and we will talk about what this new decision means for you individually and for your businesses or your entity. Okay, so let's get started, right? Let's start with the basics first. Saqib or Mohammed or whoever else wants to answer this, what does the new UAE tax resident definition actually mean for individuals? Do you have a general overview that you would like to share with folks here? Because some people might not be aware of what does that, the actual implications of the UAE tax resident definition has for them.
I think it's pretty much simple and straightforward. We need to go back to we need to understand the whole tax structure out there in the market. I know that, of course, UAE is following the footsteps of the bigger economies around the world, and it's like creating something very new for the local residents and people who are residing in UAE, or they've been living in UAE, they are doing businesses in UAE, or they have they've been generating incomes out of the UAE. So they have to understand the overall tax criteria and the resident concept. So it was sort of a very big news for everyone, of course, and we had to go back and we had to sort of go through the whole decision. The actual thing, what we need to understand from the tax residence point of view, because there are people who've been living partially in UAE, partially in maybe some other countries. They've been traveling around, they've been living around, they're doing businesses, they have businesses around the world, not only within the UAE, outside the UAE, maybe to some within some other countries as well. So it's really important to understand that how they can become a tax resident within the UAE, of course. So there are
Right.
major two criteria which have been, kind of announced by the cabinet, and they took a decision on that, and they defined the criteria for everyone to be sort of declared as a tax resident within the UAE. Now, the first portion or first part is very simple and straightforward. If you have been living into UAE and you live for the continuous 90 days, physically be present within the UAE within the 12 months period of within like total period of 12 months, you can say that you lived in UAE for more than 90 days, physically straight 90 days. So you can actually consider yourself as a tax resident, of course. And on the other hand, if you overall kind of live within the UAE, physically be present within the UAE for more than 183 days overall, within 12 months period, so you can also consider yourself as a tax resident of UAE. But even if you like sort of try to apply this whole criteria to yourself or to anyone individually, because there is no income tax within the UAE, there is nothing to apply which can be directly applied to your income or as a taxation. So that means there is nothing to worry about. But only thing is you need to understand, because of course overall UAE has signed up a lot of tax treaties with a lot of governments, and I'm pretty much sure maybe you'll have some questions around that as well later in the session.
Right.
So of course we need to understand that the people who have different nationalities coming from different countries. So how does this tax residency rule will actually apply to them? So everyone has to go back and they need to see, they need to check, they need to understand the overall structure of it.
That's super interesting. So Saqib, what I'm understanding is that yes, there's two ways for us to determine whether you are a tax resident of UAE or not, right? First is that have you been living in the UAE consecutively for 90 days, right? And this could be on a visit visa or a work permit, right? It does not matter, even if you're on a visit visa, I assume, right? Is that correct?
No, I think it's really important to again understand when you are on a visit visa. So technically, you are not a resident of that particular country.
Yes.
Right.
If you are on a tourist visa or on a visit visa, so you are not a resident. So you need to have a valid residency within UAE to declare yourself or consider yourself as a tax resident of UAE.
Got it. So you would have to be have a residence visa here. You would have to live here for continuously for 90 days or a total of 180 days in a year. Is that correct? Right. And if that's the case, you become a tax resident. But a tax resident doesn't really have implications on income tax because UAE does not have income tax, but it has implications on your corporate tax. So this applies to both people who are owners of sole proprietors like LLCs and corporations as well, I would assume, right? Okay.
Absolutely.
So could you tell us what are some examples of countries that UAE has a double taxation treaty with today?
We have a lot of examples on that one, like Portugal, like Italy, France. We have this is a long list of the you
I
can
think
say
that's
countries.
137.
Yeah.
approximately.
137. Okay, so basically, a lot of these countries already have double taxation treaties with the UAE. So that's fantastic. So in this case, let's take some examples, right? So let's say that you are a German company, right, who has a branch in Dubai, right, and they have a taxable income of let's say 300 million dirhams, right? Now, in Germany, the company is actually subject to about 15% corporate tax rate, right? Including the branch income that is coming from Dubai, right? But with this new tax residency rule, is the company able to elect to be taxed at the UAE corporate tax rate, which is around 9%, or not? I know it's going to be a pretty tough question, but would just love
No,
to get a
I am actually, kind of smiling on this question because
yeah.
we've been actually facing the same question since last November, I think, and
Hmm.
every day people come to us, they ask us that the same question when it comes to their country, when it comes to their, country they are residing currently, other than the UAE. Now, the first criteria, of course, I clearly understand people will have a lot of questions, but they have to separate themselves individually from the companies.
Hmm.
So first, they need to understand that every company as a separate legal entity has to be considered as like a natural person or of course a theoretical person in that particular scenario. So the example what you have given is there are two different or very important questions to ask when it comes to deciding that the company will be taxed or subject to tax in Germany or that will be subject to tax in UAE.
Mhm.
So if we go back to the degree law which we received, of course, and you go back and see that how they have tried to define the overall structure of tax residency or fixed place criteria.
Yeah, exactly.
Now, if you go back and see, so the criteria is very straightforward. That actually says if your company or the corporate structure or a juridical person, of course, if that is residing within the UAE and that has a fixed place, that is called the fixed place criteria. If they have, if that company has a fixed place, for example, having shops, showroom, warehouses, or so many other things, so where they can consider that company to be residing within the UAE or within that particular country where we are discussing now, or like uh, the subjective country. Now, in that case, if you feel like that that particular country where that company is residing has a particular rule regarding the corporate tax and does not have the double tax treaty with the other government, so
Mhm.
then the criteria of calculating the tax will be entirely different from the other criteria when there is basically double tax treaty.
Mhm.
Now, in this case particularly, for example, if Germany has a double tax treaty with UAE
Mhm.
and a company based in Germany has a branch in UAE, so first thing we need to understand that if that UAE branch is considered to be a fixed, like a tax resident within the UAE or not. So that is a question number one.
Hmm.
Or a permanent establishment, of course, the PE. So if that is considered as a permanent establishment within the UAE or not. So if that is considered as a permanent establishment within the Germany, so of course the overall income even being generated by that branch will be accumulated under the company established in Germany, where that will be taxed
Mhm.
entirely. But in other scenarios where a company has business back in Germany, but they also have business here in UAE, and they actually sort of consider themselves as a permanent establishment within the UAE, just because based on different criteria has been of course set by the degree law. That is the fixed place criteria, of course, and there are basic two rules to understand. So in that case, if they decide that yes, or they declare themselves as a fixed permanent establishment within the UAE, so they will combine all of their income within the UAE and that will be taxed within the UAE.
I see.
So
I
that
see.
is the actual criteria, and that is really subjective. The question is that how you actually apply, how does that apply to your overall structure? For example, when there is no double tax treaty,
Yeah.
then the scenario is completely different, where they have to actually go back and they have to look into the rules being set by their home countries. So, for example, UK might, United Kingdom might have a different rule from Germany.
Mhm.
United States of America has a different rule when it comes to permanent establishment or considering the tax residents outside the USA. Even they are generating income outside the USA, so they even have to combine that income back or declare that income back in the USA. So
Right.
in that criteria, everyone has to individually consider their overall structure. Then they have to come back and say that okay, this is what actually applies to their overall structure, where they have to combine, where they have to be taxed, which country they have to be taxed.
Right. So just to summarize, so essentially it's like based on the double taxation treaty. And so the subjectiveness is depending on a few things. First is whether that country has a double taxation treaty. Second is, are you considered a permanent establishment in UAE or not? Right. And the third is the criteria that we mentioned earlier of the individual versus the corporation, right? The tax residencies. Based on these three requirements, you may have to, if there is no double taxation, you're going to have to look into the laws of that country, right, to see what part of the income from your branches feed into the tax that is eligible, for example, in the States or anywhere else, right? And what part of it needs to be accounted for in the UAE, or is it both, right? And that really depends on the law of the country that you're working with. But if there is a double taxation treaties, could you elaborate on that part, Saqib, a little bit more? Which is, if there is actually a double taxation treaty, what happens then? Like you
So
are,
every
yeah,
single double tax treaty has to be might be different from. It actually varies from one treaty to another or one country to another. So you have to, the subject company or the individual has to go back and look into the actual criteria being agreed between both governments.
got it.
The overall requirement of having a double tax treaty is not to actually tax the same person in
Twice.
both two
Right,
different countries. So there shouldn't be a double taxation.
right,
So that is the reason when they actually sign up these kind of agreements between
right.
different governments, and they try to like safeguard the
Yeah.
individuals or companies for being like double taxed.
So
So
this
in
is
that
actually,
case,
sorry,
yeah.
just a quick one. This is actually a very important point that you just mentioned, which is that double taxation treaties are actually different on a per country basis, which means the UAE might have a different double taxation treaty with Germany. They may have a different law with UK, etc. Is that correct?
That's correct. Yes. Because but when it comes to the like setting a law or like a basis of considering individuals or like companies, like tax resident of a particular country. So generally, it is same. For example, for the individuals, it is 180 days. Generally, it is the same, but it can be different, of course.
Perfect, perfect. Sounds good. Sounds good. Looks like we have a couple of questions actually. Firaz had a question, and I think we got this question before in our first webinar that we ran several months ago, Saqib, which is that does this tax apply to all business, or is there an income threshold, right? And I think again, this comes back to the thresholds that we described in our first webinar. Saqib, did you want to like quickly recap that so that Firaz is aware of the income threshold as well?
Thanks for us for asking this question. It is going to be applied to every single company being registered within the UAE, regardless of their legal structure. But every single company has to actually register. But now, it actually, if there is any sort of, do you have like exception or not? That is the second criteria. So the first criteria, of course, every single company has to register for corporate tax. Now, there could be some exemptions, of course. There could be some low income, benefits or exemptions for the SMEs, for the small and medium enterprises, those who have the very low income. But the exact criteria is not being, released so far. But the income, of course, there is a threshold, and the threshold is 375,000 dirhams in a particular, financial period on of your net income. So your net income or any business net income exceeding 375,000 dirhams will be taxed at 9%. So just to give you an example, if you earn 500,000 dirhams worth of net profits, if you report those net profits within the 12 months period, financial period, so the first 375,000 dirhams will be taxed at 0%, and the remaining 125,000 dirhams will be taxed at 9%. I hope it clarifies the question.
Perfect. For us, if you can tell us a little bit more details about, where you have other branches, right? And if you want to follow up to that answer that we just gave, please do add a comment, and we'll be able to take that question on as well. Looks like Shreya has a question as well. Shreya's question, and I think I know the answer to this, but Shreya's question is that would also like to ask if the info you're sharing also applies to a free zone virtual company in Dubai. So by virtual, I think what Shreya means is that I was just looking at Shreya's profile. She runs a digital agency focused on marketing, right? So Shreya's question is, if I don't have, a branch, or if I don't have a physical establishment, right, where I am doing most of my work online, and I am a free zone company, does these laws still apply to me?
Yes, exactly. Still, these laws apply.
No, absolutely.
Yeah.
There's no doubt about
There's
it.
no doubt about
But
it.
the question is that because when it the first time when the law was actually like pre-consultation document, or what they call that document,
Um,
pre-launch document or something,
yes.
right? So that document actually, when that was released last year, early last year, so there was a whole criteria on the free zone companies, and that there is still a criteria for the free zone companies, and that those companies might be actually considered as exempted from some of the like laws or rules being set by the government.
So let's break this question in two parts. One thing, the laws are getting implemented on a particular company or not. That will be implemented. That's for sure. The second thing, whether it can be a taxable thing or not, that is totally depend upon the income. So if we have an if she having gonna have an income which is actually what you can say, what term they use,
Below the threshold, or
no, not the threshold, that income,
Flexible income.
not
Exempt income?
exempt income.
Yeah,
If
yeah.
it is that, under
Qualified
that
income.
qualifying income, so
Basically.
that's the right terminology. If it is a qualifying income, then there is a different criteria for that one, and then
Exactly.
that company even not.
So regardless of you being virtual, or regardless of you being within the free zone, having virtual company, having no physical existence, you have to actually register for corporate tax. That is the
Yes.
first thing.
right?
So there is no exception for that. So this should be clear. Number one.
Yeah.
Number two is that your income particularly, because law actually says that for the free zone companies, if a particular company is having or generating a qualifying income, then yes, that qualified income will be exempt from the corporate tax. But I can give you an example. If you have a free zone company, and that free zone company is actually generating income from mainland Dubai, then of course it has to be taxed, because you're generating income from within the UAE. There is no doubt
Right.
about it. It has to
Right.
be taxed, of course. But if you are generating income outside the UAE, maybe there could be some exception for that. But what are the qualifying income streams? We really, like we are also waiting
Waiting
really
for that.
anxiously on
Right,
that.
right. So,
That is the hottest topic, of course.
Yeah.
so just to summarize for Shreya, regardless of whether you are a free zone company or not, you still have to apply for corporate taxes, right? You still have to file your taxes, and you still have to do all of those things, regardless of whether you're a virtual company or not, right? So if you're a registered company in UAE, whether you're in free zone or whether you're in mainland, you still have to apply for corporate taxes. Now, in the corporate tax regime, there are certain things that count as qualified income and certain things that do not qualify as qualified income, right? And as we answered Firaz's question before, corporate tax applies to any company where their qualified income is above the minimum threshold that was stated, right? Which is, you mentioned 350,000. That's correct, right, Saqib? 350,000. So your qualified income needs to be more than $350,000 dirhams per year. Is that correct, or is it on a quarter
No, the
basis?
qualifying income will be entirely exempt from the tax, the corporate tax. But if you have a mix of qualifying incomes and non-qualified incomes, then you have to actually allocate the expenses to qualified income and
Right.
calculate it, and then that stream will be exempt. But for the remaining part of the business, which is non-qualified, that will be definitely taxed at the same rate of 9%.
9%. And that non-qualified income, that's the threshold is 350,000 per year, or is it on a per tax?
The criteria is very simple. For non-qualified, it's 9%, of course, but for the qualified, there is exemption. But the criteria is, of course, that is the basic criteria is same. 375,000 will be 0%, and anything over and above will be taxed at 9%.
Perfect. And that's for the tax year that is there, right? So
For the
Shreya,
tax year, of course. Yes.
exactly.
Uh,
So
so
Shreya,
for-
yeah. So Shreya, what you have to do now is that you would have to figure out whether the expenses slash the income that you're getting fall under the qualified income criteria to be exempt. Now, that qualified income criteria has actually not been fully released yet, right? It is going to be released hopefully in the next few weeks or months or so, right? But yeah, the best thing to do here is for you to work with a tax consultant, do a health check, see what percentage of your income would fall under qualified income and not, right? Because you may be working with a lot of clients that are outside of UAE, right? But yeah, those tax laws haven't been released yet. But once they do, we will do a webinar follow up with them as well. I have some follow ups from, so Shreya, if you have any more follow ups, please do leave a comment, right? And we'll be able to answer that. Okay, I have following up from Firaz's question. So Firaz is asking, so registering is absolutely mandatory, and yes, that is correct, Firaz. All UAE businesses have to register for corporate tax, right? But he's asking, but paying will be zero if the income is below the threshold, right? Which is yes, which is somewhat correct. Again, it's all very subjective, right? Because it depends on what constitutes as qualified income versus non-qualified, and then your non-qualified income needs to be below the threshold, right, for you to be able to be exempt from or pay zero tax on that. Is that correct, Sakib? Am I?
Absolutely, you're absolutely correct. I completely agree. But the major, like very important factor and point is that every person needs to sort of go back and check internally that what kind of income stream or overall businesses they're kind of running. Are there any sort of structural changes or reforms they need to actually do? Are there any accounting structures they need to change? Of course, change. Maybe they have to actually change the overall accounting policies. Maybe they might have to change the, like the overall legal structure of the company. Maybe they might have to change. So they need to actually reconsider their overall structures, whether it is legal, whether it is accounting, whether it is chart of accounts or anything. So that has to be reconsidered. That is number one, very important thing. But on the other hand, of course, this is not going to be, a very simple criteria, just like that. We used to have like, okay, this is 5%, this is exempt, this is not exempt. Simple. If it is this much of sales you're doing, so that is taxable, and you have to register, you have to charge 5%, you have to, and you can actually set it off with the expenses you pay or 5% on top of that. So in this particular scenario, the corporate tax is of course not going to be very simple for some of the companies. It's obviously it is going to be very simple for a very small business like a general store or a supermarket or a very small business where they only have one particular business and they are sitting over there, they are generating income, and they know that this is how much they are generating. It's very simple.
Mhm.
But for those companies, those who having ties in different countries, having roots in different countries, living in different countries, generating incomes from different part of the world, and they need to understand that they need to actually reconsider their overall structures, and they need to see that, look into their overall structures, that how they might have to restructure, they might have to change something. So this is very important actually. And on the other hand, just like Firas, for example, he asked this question. Every other person is asking this question. So without being getting confused about the corporate tax, I think the best way is to ask someone who knows, or maybe just read it through. They have done a tremendous job. If you just straight away go to the tax.gov website, you can see a separate section of corporate tax. Just refer to that, and you know that everything is there. It's very simple and straightforward. But yes, if there is any complication, then you might have to actually sit with your accountants, with your lawyers or tax consultants to reconsider it.
Perfect, perfect. Sounds good. So, so for us, just to answer your question, yes, registering is mandatory. But if you want to find out whether you have qualified income, non-qualified income, and whether your non-qualified income is below the tax threshold, you will need to refer to the rules, and we will need to take a deeper look at your structure and where you're getting your income from before we can answer that question in a more detailed way. But yes, there is a possibility that you may have to pay zero income, zero taxes, or a zero rate tax if your non-qualified income is lower than that threshold. But yes, that is all subjective, right? We will need to take a deeper look at how you're doing your accounting, etc., to be able to actually properly answer that question, right? So hopefully that gave you a little bit more perspective, right? Now, I have actually a lot more questions. Uh, Ailen Wei, I hope I'm pronouncing your name right. Sorry if I'm not, but they mentioned that it was mentioned earlier that the entity has to register itself for corporate tax. Do we have an automatic registration with FTA if we already are a VAT registered entity? If yes, and if not, can we do this through the FTA portal? Now, I remember from our last conversation, Saqib, which was that there is no automatic registration, right? You will have to do it yourself. But has there been any changes or any deadlines being shown around the registration timelines or anything regarding registration that has changed since last time we chatted?
Till now, it's same.
What happened is actually is they released a guideline for the corporate tax registration. So far, it is not mandatory. When we say mandatory, that there is no deadline, given deadline for registering the businesses for corporate tax. So it's pretty much simple. But of course, it's not going to be automatic. So every person or a business, whether they are registered already for the VAT purposes or not, they still need to register themselves for the corporate tax. So it's going to be, of course, manual thing. Of course, everyone has to register separately for the corporate tax. But yes, there are some companies, there are some organizations who have been invited, particularly by local authorities, to register right away. For them, yes, it is already considered as mandatory because they must have been receiving a deadline to be registered. But if somebody has not received, so that means it's not mandatory for them so far. But when we will be definitely closing to to 1st June or a cutoff period of corporate tax, so we might have some changes over there. But so far, yes, we have already received a guideline. It's very detailed one. It's very detailed document, simple, straightforward document, but a detailed one. They have actually shown all of the criteria. They have shown the complete details how to register, what forms they will see, what information has to be uploaded. Every single detail is there actually. And in that case, you have to actually go back and you have to actually register yourself or your business separately for corporate tax. And that for that particular reason, you can always use the same platform, Emiratex.
Correct. So what I'm hearing, Saqib, is that an actual deadline of when you need to register by hasn't been communicated yet. Is that correct?
No, there is no actual deadline, but yes, when we'll be, there could be some deadlines coming in, maybe before 1st of June or something.
Right.
But so far, no, there is no deadline. You can say that why there is no deadline. Of course, let's just take an example of those companies, those who have the tax period or the financial periods from January to December. Let's just say. So from January to December, companies has their first financial period will be for taxable period will be 1st January 2024 till 31st December 2024. So that means any company having a financial period of Jan to December, their first tax period will be 2024. And then they will have 9 months following that period. And in those 9 months, they will be given, it's a huge, like a complete timeline is there. It's not very, a short deadline or a short period. So they will be required to file and submit the corporate tax return before September 2025. By the end of the September. So it's a huge deadline. So there is no such, like sort of a criteria or deadline that you have to register right away. No, it's not like that. Only for those companies who have been specifically invited from the authority, by the authorities to register right away.
Right. So that's super interesting. So certain companies have been invited by the authorities to register their company for corporate taxes, Whereas for the rest of the other companies, there has been guidelines that have been presented, right? And there has been approaches being shared on how to register, which is again through tax.gov.ae, right? But there's no actual deadline, and that deadline for filing your corporate tax actually depends on your accounting cycle, right? Because when you close your books, you have 9 months from that time to be able to file that corporate tax. Is that
Yeah,
correct? Yeah.
that's correct. That's correct.
Okay. So hopefully that answers a lot of the questions here. I think there has been multiple questions here that are talking about this, right? And we have put in a link to the FTA website below as well, right, in the comments. So please take a look at that. Um, we've been getting a lot of questions recently, actually even for a lot of Pluto's customers, because a lot of Pluto's customers are keeping track of their receipts, their expenses, their reimbursements within Pluto. And one of the questions that has been coming up a lot is that what Shreya is asking actually, which is, what are some of the most common deductions and credits available to businesses under the UAE's corporate tax laws? And, what should companies be doing today to be able to take advantage of these incentives in the future? For example, should I be keeping track of my receipts, my invoices, etc., in a very particular way? Like, what are some of the things here to be able to reduce their tax liabilities? Has there been any guidelines there, Sakib?
Yeah.
I think Guru can answer this.
Yes, there are a long guidelines which is already provided in the law. The important thing is this: right now, we have to plan. Every company have to plan for their books of accounts, how to manage their books of accounts. Every company have to look into their financial recording system. Every company have to look into the structure as well. This is the one and most important thing, because corporate tax will require the record of each and every penny you are going to spend, that you're spending, and a record for whatever you are earning. So for spending perspective, there are some deductible expenses which are specifically mentioned in the law. So these expenses you can deduct from your income to reach at a point of the net profits. There are some expenses which they clearly mention, these are non-deductible expenses. You cannot deduct that. There are a couple of expenses which you can 100% deduct. Couple of expenses which you cannot deduct at all. Couple of partially you can deduct from your income, and partially you cannot deduct. So there are in totality there are three categories. One which you can 100% can deduct from your income. The other which you can partially deduct from your income. The third one which you cannot deduct at all from your income. So there are three basic categories. But before jumping into these three categories, we have to understand the nature of the expenses. So the nature of the expenses in accounting terminology, there are two natures. One is revenue expenses, the other is capital expenditures. So while we're looking into the revenue expenditures or revenue expenses, these are the day-to-day expenses, like your salary, your printing and stationery, your courier services, all whatever you are trying to deal to cope up with your business. So all of those expenses which you are meeting day to day, these are the revenue expenses. So these expenses are deductible or partially deductible or non-deductible. But the capital expenditure, while you looking at the capital expenditure, what sort of capital? Capital expenditures are those expenditure while you are making that expense, but the benefit of these expenses are not limited to one tax period. It will be like lead to the preceding years as well. So those capital expenditure, these are not deductible expenses, because your these are going to be your assets. These are not
Right,
going to be
right.
your day-to-day expenses. So this is the basic classification in that one. But there are some classification under which expenses you can deduct 100%, partially, or non-deductible.
So, Sakib, sorry, Mohammed, in the 100% deductible cases, right? So those are revenue expenses. Could you give us some examples of those things? Like, what could be a potential example of an expense that I should keep track of so that I can get some tax deductibility in the future?
Yeah, there is a lot of like examples which are 100% deductible, but on the basic level, what how we have to identify the deductible expenses. Basic definition is that particular expense have been done particularly for that business, for the taxable person. So when you speak like taxable person, it means that particular business. If that expense is 100% related to that particular taxable person, then you can deduct it from your revenue. This is the first rule of thumb. The second, like your printing, your salaries, like your other day-to-day expenses. So there are long list of those expenses which you can deduct from your revenue. But that again, that should not be your capital expenses.
Mhm, mhm. That's super interesting. So let's take, for example, that I am um spending some money on a supplier, for example, right? To be able to incur some costs for my actual production of goods, right? This could be, and I'm paying certain expenses there. Some of those expenses, I would assume, would be deductible because that I am using directly to generate my revenue. Is that correct?
Yes, look, this is a perfect example. Like this is your directly attributable cost towards your business.
Right.
There is no personal thing. There is nothing. You are bearing that expense directly towards to generate that particular revenue. So this is 100% deductible expense. You can deduct that from your revenue.
Perfect, perfect. Sounds good. Sounds good. Okay, so following up on this, what Shreya was asking was that, you know, she has a free zone company, and right now there's a lot of ambiguity on how to apply VAT on the invoice of the clients, right? Especially the difference in an import invoice within UAE versus export invoice. So she is very curious to hear about, how should she be applying VAT there, and how should she be like keeping track of these things so that when it comes to the future of filing the corporate tax, she has a good source of auditing done here.
I think VAT is you need to consider VAT from corporate tax completely separately. Like you have to define both of the four types of taxes separately. When it comes to VAT, which is value-added tax, that is generally being applied on the consumer of services or the products.
Hmm.
For example, when we are providing services to any of our client, let's say accounting, taxation, or any other relevant service we provide, and we actually charge them 5% on top of that invoice, that 5% is my responsibility or my business responsibility to pay back to the government
Right,
because that has to be applied to the consumer of the product or service. Now,
right,
she has mentioned two different criterias when it comes to invoicing the clients within the UAE and outside the UAE. Now, if your clients are residing outside the UAE, that does not mean that you do not have to actually apply the 5% on your invoices, or you have to charge 5% or not, because we have to see your products or services being exported outside the UAE will be considered as zero rate. So there you do not need to actually apply 5%, of course. But if your client is residing outside, but the services are rendered within the UAE, or the products have been delivered within the UAE, so those will be, of course, considered as that invoice needs to be taxed at that will be a taxable standard rated invoice, and that has to be taxed at 5%. This is the first criteria. Now, whether you have to charge 5% to your clients within the UAE, yes, you have to if you are providing taxable services or taxable supplies. If your product or service is not actually kind of exempt service or zero rate, then yes, you have to charge 5%. And given that you are registered for VAT with the FTA, if you're not registered, of course, then you have to first register. And why you have to register? If it actually kind of reaches a criteria or threshold, which is 385,000 or 80,000 dirhams approximately, taxable supplies within the total period of 12 months, which is kind of defined as 11 months, previous 11 months, and 1 month the future, next 30 days. If you consider that you're going to cross that criteria or threshold, or you've already sort of crossed that threshold, so it's kind of mandatory for you to register for
right,
VAT and then start charging 5% on from your
right.
clients. within the UAE, of course.
So
Here,
Shreya,
Mr.
yeah,
Ridwan, one very common mistake which some service industry businesses are doing. If you are a service industry and you are invoicing from even from one designated zone to another designated zone within the UAE, still you have to charge 5%. In products, it's zero
Hmm.
or it's 10, but actually it's out of scope from one designated zone to the designated zone if it's product. But if it is service, then you have to charge 5%. This is one common mistake a lot of
Got
service.
it.
I think that's because not just one. This one, there is another one which we were discussing last time. If you remember that a company being registered within the UAE, but they are kind of providing services completely outside the UAE. That
Right,
means
right,
that the people actually going outside the UAE, like sitting outside the UAE, providing services, rendering services outside the UAE.
right.
They were actually kind of considering those services as out of scope, not even the zero rate, because zero rate has to be reported when while filing the return. That is the difference actually. If your service or product becomes out of scope, or that taxable transaction or that particular transaction becomes out of scope, then that should not be reported at all. But in
Okay.
that particular scenario, we had to actually come up, like we were discussing, and then we were trying to explain to the client that that particular service, even though you are actually sitting outside, residing outside, and kind of rendering the service outside to, like a client which is maybe in UK or anywhere else, so that service has to be reported as a zero rate service. You can't
Got it.
actually consider that as out of scope. You can't actually just skip from not, or you can't just
Reporting,
exactly. You can't just sort of decide not to report to the authority while by just considering that it's out of scope. No, that has to be reported as zero rate service.
Perfect. So Shreya, as you can see, it is actually fairly complex, right? And we would need to, you are in a service industry, right? So I think your approaches might be very relevant to what we discussed here. And looks like SA has a lot of experience with this. So if you do want to reach out to them privately, you will have access to their DMs. And we've also added a link to SA Consultants below, right? They have tons of experience working with very similar companies like yourselves, right? So they would be definitely be able to help you there, look into it, and give you a definitive answer as to whether or not this is applicable to you. But yes, I think better to do this sooner than later, right? So that you don't have to pay that 5% out of your own pockets later on, right? Great. Okay. So I have some clarification for Firas. So Firas is like, I think he said that the threshold is 350,000 and it will be taxed at zero rate up to 375,000. No, this is not correct for us. The threshold is 375,000, right? Which any amounts above that 375,000 threshold may be taxed at 9%, right? But that is subjected to qualifying income versus non-qualifying income and various other aspects to it. Is that correct?
No, I think this is very important, as Omar actually mentioned, all of those deductible and non-deductible expenses. Because when we say threshold, the threshold is actually the net reported profits. How you actually come up to those profits, that's another question. So it's basically income streams. Those could be, yes, qualified income streams. Those can be exempted income streams. But then there are expenses. Those are deductible or non-deductible. Those are adjustable or non-adjustable. Those are, those are the expenses. Then there are other expenditures you can deduct or not deduct, like cash expenses or non-cash expenses, like depreciation and all that kind of stuff. And then you will, reach to a point where you will say that, okay, this is your total net profit according to the laws or rules being set by the local authority to calculate your net profits. So if those are not according to your to the local authorities' guidelines, then that means you are not calculating that net profit rightly. Now there could be some instances, or maybe we have been advising our clients to start thinking about restructuring the books of accounts, or maybe to have like two set of accounts. Because, for example, if you Ridwan, you actually sit with a client, or maybe you come to us, we are your client, and you take us for a nice dinner, which is, by the way, still pending. So, And
I'll make it happen soon. No problem.
that expense, for example,
Yeah.
maybe you spend like 500 dirhams. Is that 500 dirhams is deductible from your business expense point of view,
Right.
internal management point of view, or from the financial reporting perspective, from the auditing perspective? Yes, that is deductible because you have spent
Right.
500 dirhams on your client.
Right.
But the local authority, from the corporate tax point of view, the decree law actually guide us that it will be deducted up to 50%.
Got it.
So that means your actual books of accounts will differ, might actually differ from the corporate tax calculation. So
Right.
you might have to maintain two set of books. One, of course, your internal books, and the second, of course, your corporate tax books.
Right.
This is specifically mentioned in Article
Exactly.
32.
Yeah.
So even not just the customer, if let's say you have a supplier, your shareholder, your partner, or anyone like that, and you are giving entertainment to those guys, still it is the same rule. It will be 50%. It is a deductible, and 50% you cannot put. So 50%, you can say 50% you will add back to your profits to reach the taxable profit. So if your accounting profit is like 100,000 and you spend like 5,000 on your entertainment, so at the end of the day you have to add back 2,500, add back to your accounting profit to reach the taxable profit.
That's right. Yeah.
So whether you're spending on your customer, your suppliers, your
And
shareholder.
exactly. Now, how this is going to be maintained? That's another point.
Yes,
right?
this is
the
point.
Of course, right? Because if you take your client to a burger joint, which is very simple, one like 25 dirham, 30 dirhams you spend. But on the other hand, you can take one of your clients to Nusrat.
Right. Right.
In that case, I'm actually like. But anyways, like it's really important for every other person to maintain the books in the right shapes. But
Right.
when when the authority will come back, maybe after like implementation of the corporate tax, they might come back, ask a lot of questions. So you need to actually have a bridge between your reported corporate tax numbers and your internally reported numbers.
Right.
So that bridge becomes really important. That how you actually maintain that bridge. That
Right.
from this income, for example, you have 100,000 dirhams worth of income, or $100,000 or $200,000, but out of that, 50,000 was actually qualified income. The remaining
Right.
was non-qualified
Right.
income. That means, but of course, that 200,000 in total, accumulatedly, that is your revenue of your business revenue, right? Which
Right.
you have to report when it comes to auditing of your books and all that, or reporting to your shareholders and internal reporting, external reporting. But when calculating your corporate tax return, you have to actually take 150,000 only.
Right.
You
Right.
will not take that 50,000. So how you
Right.
will actually bridge that? So that 50,000 within the bridge will be very important. That how you actually maintain your data, how you keep the record of that proofs of your data, receipts and everything. How you actually maintain that in a way that even authorities come back after 5 years and you need to have those answers with you.
Yeah.
You can't just say that it's been 5 years. No.
Absolutely. And by the way, this is an extremely
To share another example,
Yeah.
which clarified a little bit more. Let's say you have one director of the company or one shareholder of the company, and he's traveling. So you arrange the accommodation in a hotel, you arrange the like lunch, breakfast, meals, and everything for him. You arrange the traveling and transportation, whatever mobilization expenses. So let's say if he is traveling and you spend on all the managing all the things, the company spend let's say 100,000 or 20,000. Let's say they spend 20,000. Still, in that case, only 50% is deductible. You cannot go straight away and deduct all the 20,000
all of them.
revenues. You have to deduct 10,000, and like your accounting expense will be 20,000, but your taxable expense will be 10,000.
That is so interesting.
The entertainment and this subject is a bit vast, so we have to look all those aspects into that as well.
Right. So for us, just to answer, yes, there is the threshold, but again, it really depends upon your book, because as Saqib and the team has mentioned, is that there's a lot of things that are deductible versus not, but they also may be partially deductible, and you have to essentially maintain two different sets of books. One is the books that you're using internally for your own shareholders. and for your own record keeping, and the other is a corporate tax book based on the guidelines that have been given. And actually, Saqib and Mohammed, this is actually a very important point because a lot of our clients as well are demanding such things. And recently, we introduced a 7-year audit log for all receipts, right? So any receipts that are now in Pluto for any kind of like travel or expenses are now held in the Pluto account for 7 years, so that you're able to manage this really well. So we are actually over time right now. And I know it feels like we just got started, right? But for everyone here who's on the call, we will be running one more webinar very, very soon, in just in the next 3 to 4 weeks, right? With more updates covering significant changes. And you can count on SA, right, for all of your tax needs and all of the questions that you may have regarding your own business. So do reach out to them. I've shared their link below. Sign up to Pluto, right? We are offering a very specific deals for anybody who's signing up through the webinars. Pluto allows you to keep track of all of your receipts, right? And this is actually extremely important for corporate tax as of today, right? Yeah, hopefully we will see you guys in the next webinar. Thank you so much, Saqib and Mohammed. As always, like always, a pleasure to have you guys on, right? We will share details about the next webinar very, very soon with the rest of the team here. But this was super insightful, and we will provide a summary of all of the points covered as well very soon.
Wonderful. Thank you so much, Rizwan, for arranging this. And I think it's really important to just highlight one last point, because Pluto has been, trying to educate people, helping others to understand the corporate tax things, and spending time investing into it. And yes, the whole platform is also one of the very important platforms. I believe that it's important that people should look into it, and they need to understand that this platform can help them to sort out their issues related to reporting and managing their expenditures, and keeping record and everything. On the other hand, of course, me and Omar, we both are available all the time. You can approach us through email, I think. If somebody has any specific question, we'll be more than happy to answer, honestly. Just write us an email, and one of our tax team can be in contact with you. They can answer your questions, and please feel free. Also.
Fantastic.
Thank you, Ridwan, and thank you, Pluto, for arranging this all. Ridwan, my recommendation for the next webinar, let's discuss the expenses, the deductible and non-deductible expenses, because this is gonna be one of the largest topic for the corporate tax. So let's have our next webinar on that particular topic, because
Absolutely.
this
Absolutely.
is the area where a lot of confusions are arising.
Absolutely. And this is actually extremely important because we got a lot of questions here. I know, Shreya, you will have a lot of these expenses as well. Faraz, Shibagami, and a lot of the team that has been here, you will definitely have these. And this is a way for you to save money, right? So let's make sure we cover that. I will share a link to the next webinar coming up, and we will cover exactly what you said, Mohammed, right? And for us, you will get a recording of the webinar. As soon as this event is over, we will share the link with you, right? You will be able to access it and be able to review it. In addition, we will also do a joint blog post with SA, right, covering all these points in details.